Greetings, members, one and all of the Salivation Nation. 5 reasons why gold is set to explode. Let's explore. This comes to us from Forbes.com. An interesting article here. There's a lot to look into, and some people have made comments recently about how I was talking about high gold prices, and they're saying it's going to go much higher, and that gold is a bargain right now. And that's the sentiment here of this bullish article for gold. And let's kind of pick it apart. Maybe we can find some things, some faults in it as we go through. I do like to try to be realistic in terms of where prices are going for gold and silver and show both sides. And so definitely, but I'm overall bullish on the precious metals in general. And why? Mainly because I see them, no matter what their prices are, as a hedge against economic instability. It's sort of an insurance policy. And really, in a sense, that transcends price. We take a look at price, and that is obviously a motivating factor. But when you think about it, it's about the dollar's valuation compared to the stable gold, and in some cases silver too. But with that being said, here it goes through this article. Gold prices are retracting from highs today after touching their highest level in more than 7 years. The gold price hit a peak of $1,779 yesterday as investors started to diversify their bets. 5 key factors are likely to push gold prices higher in the coming days, not necessarily weeks, but in the coming days. So this is very interesting indeed, how this where this is going. Coronavirus second wave. Again, as I mentioned in a video recently, in a way, I don't think we're out of the first wave yet. It's just a sort of another ripple that's gone up. Investors are largely risk averse due to the threats of coronavirus second wave. New cases have started to surge in around 20 states, actually. It was expected that there would be some spike in coronavirus cases as economies began to reopen, but what wasn't priced in was that the situation would start to get out of control as it did in Texas. New cases have soared 4 to 5%, and hospitals are close to their full capacity. That's the scary thing. Australia has reported its largest one-day spike in coronavirus cases in nearly 2 months, and this has raised alarm bells of a possible second wave. The UK has announced the reopening of its pubs and restaurants, and travel restrictions are likely to be eased off from next month. Remember, the UK was one of the worst countries in terms of dealing with the COVID-19 crisis, and it has the 3rd largest casualty rate due to the coronavirus. If appropriate measures are not taken and respected, we will probably see another coronavirus wave coming to the United Kingdom. Of course, positive news on the coronavirus vaccine or success in calming down the protests and protecting the global economy from damage can keep the gold prices in check, and this may halt the sharp rise that the author is expecting. And keep in mind that there are some announcements that in July and August we may see phase 3 trials of 2 different manufacturers of a vaccine. We'll see how that plays out, but by and large, we're not going to see any vaccine at all until at least next year sometime. Possible new tariffs on Europe is the next thing that we're looking at here that could cause prices to go up in the coming days. Donald Trump, the man who's known for escalating trade tensions, anchored trade tensions once again yesterday. Trump is weighing new tariffs on $3.1 billion of exports for the United Kingdom, Spain, France, and Germany. If tensions continue to rise on this issue and Trump doesn't back off from his stance, which could be one of his tactics to show himself strong ahead of the U.S. elections, investors are likely to steer away from riskier assets. However, if for some reason the trade tariffs are avoided, the investors do not see this as a potential threat to global economic growth. Gold bulls may not succeed in pushing their gold price higher. Then we have the China-U.S. trade war as the 3rd reason that prices could go up. China is not a country that is going to sit on its hand and let Trump administration to bully it. The Phase 1 U.S.-China trade deal has become immensely fragile due to the coronavirus. China has reduced its agricultural and poultry from the U.S. There has been confusion about the U.S.-China trade deal, and Trump has also talked about decoupling from China. In addition to this, China sees the U.S. stance on Hong Kong as interference in its domestic affairs. Traders do not like the U.S. picking a fight with the second biggest economy in the world, and we have seen the evidence of this last year that jolted the U.S. stock market. If for some reason we see the relationship between the U.S. and China getting back on track with no further threats to the U.S.-China trade deal, we may not see a massive surge in the gold price. Now keep in mind, we really do have the upper hand with China. And it's no mistake, and I think the world agrees, that China it was the one that was at fault for letting this coronavirus get away. And so, especially by not allowing the flights into other parts of China, but allowing flights to go out from Wuhan to other parts of the world. And, the Phase 1 trade deal has some language in it that basically refers to the virus and no certain terms. But make no mistake, we do have the upper hand there, but the overall sentiment is that there is problems that tension to what of unsettlement in this is concerning, and that will continue to press the markets for sure. Then the U.S. unemployment claim numbers is another reason, is the fourth reason here. The weekly jobless claims continue to paint a very dull picture for the U.S. labor market. Sadly, with the regional shutdown of stores in the U.S., it seems a minor recovery we have seen so far could be under significant threat as well. In simple terms, the unemployment claims numbers are already ugly, and they are likely to become even worse because of companies like Apple have begun the process of reclosing of the stores in the U.S. coronavirus hotspots. But that's kind of related to the coronavirus increases. They're kind of tied together because obviously pausing of shutdowns or pausing of reopenings and maybe businesses themselves deciding to shut down aside from any state mandates. The job market is the most important for the Federal Reserve, and Fed monetary policy is highly reflective of this. The Fed is determined to keep the interest rate lower for longer, and they're unlikely to increase the interest rates anytime soon. In fact, some people are talking about that they may actually go negative with those rates. Another major central bank, the Bank of England, has provoked a new idea concerning interest rates and will not increase the interest rates while the government balance sheet is mammoth. Andrew Bailey, the governor of the Bank of England, has talked about this, and likely the Fed will also pay attention to this notion. Well, what is that? That's negative interest rates from what I hear. Then finally, the earnings season. The third earnings quarter is currently wrapping up. At the beginning of this quarter, there is some hope for improvement as the economies began to reopen, but the emergence of the second corona wave is likely to trigger another cautionary note from U.S. companies. Investors are not going to like it. The U.S. stock market rally that we have been seeing after the COVID-19 shock, stock market could lose its momentum, mainly because a lot of it is propped up by Fed money, by liquidity from the Federal Reserve. Again, the risk-off mode is likely to spur interest in gold. If U.S. corporations start to focus more on the positive side, and for some miraculous reason their cash burn ratio goes down, we may not see much movement in the gold price. And we also have to take into account and consider as well that these numbers that are kind of back and forth on housing, jobs, and earnings data, we'll see what happens when the numbers take place and how serious this recession really is. So that couples in with this last reason, how serious the recession is, the GDP, what the GDP numbers will be. Those are all going to be all factors. If we get really bad news and to where this recession can actually be measured, that could head us into a worse situation, which could cause these prices to go up. But it's going to all depend upon these numbers as the third quarter comes into play and as wraps up here. So there you have it. 5 reasons why gold could explode sooner rather than later. I hope you enjoyed this video. I'd like to extend a multitude of gratitude to you all for taking the time to watch and encourage you to please rate, share, comment, and subscribe.